Good evening, students. I hope you're all keeping safe and got a chance to recap what we did day before yesterday. Welcome everyone to the second part of the cost of capital session. This is again your friend, your mentor, CA Manubhav Verma, and I'm looking forward for yet another interesting session for the day. And before we start, I had a couple of queries from the query box. So Srishti, I think you had a valid point regarding the taxability rule. Now that is absolutely fine. So that will always be dependent on the current tax laws. So don't worry. So whatever the current tax laws is, that will be followed. And that's why I said that, the taxability portion will be anyways, more of a concern in taxability paper. But in any case that, talking about in that particular question itself, you can follow the current law and you can actually mention the assumption or rather the facts you have taken. And to your second point for illustration 4, let's take care of at the end, maybe if the time permits us, because I think that is a very simple or straightforward illustration where you have a deep, I can just give you a brief background. A deep discount bond is where, you don't pay interest. So that's why the issue price was 2,500 and the redemption price is 1 lakh and it's like 25 years. So you have to again follow a hit and trial method to kind of get a IRR over there. So good evening, everyone. I can see a lot of responses here. I'm sure you are all excited as I am for the evening. So before we start a day, just quick recap of what all we did on Thursday. We talked about various sources of cost of capital. We talked about cost of debt. We talked about important terminology over there. We spent good enough time, almost more than 1 hour spent on the long-term debt itself. Then in the later half, we talked about the preference shares, models related to the equity shares, and also retained earnings. Now, let us, before we move to the the deep granularity of the concept, especially weighted average cost of capital, let's test you all maybe let's start with a couple of MCQs. What do you think? So let's start the day with a bang here. Question number 3 and question number 4 on your screens. That's what I want to start from, just to see how much of it you recall from what we did on Thursday. So I want your responses on the query box along with the question number. What do you think for question number 3? And what do you think for question number 4? And you are getting 2 minutes for both the questions, right? And your time starts now. Interesting. So the time is up. And out of all the answers, what I can see, I think majority of you are giving me a common tone here. For question number 3, the majority of you are telling me D. A couple of answers kind of deviating from D as well. Like someone said C as well, I guess, right? So Gilberta, you said C. Everyone else looking at D. And fourth, I can see unanimously it's about A. So which of the following statements are false? Retained earnings do not involve any cost. Yes, do you think retained earnings do not involve any cost? I guess they involve cost, right? They have an implicit cost. So this definitely is a false one. Weighted average cost is sum total of cost of capital from various sources. Although we have to do the weighted average, we have to still cover the weighted average, but it's not sum total. That's the problem here. Then we're talking about tax shield on preference dividends reduces the cost of capital. Do we have tax shield on preference dividends? Really don't think so. So absolutely correct. Option number D for question number 3 is definitely the correct answer, guys. Now, moving on to the last, the fourth MCQ, interest on government bonds is also known as. Now, that was tricky. If you remember, we talked about how the security market line falls across with different returns. We also talked about that the least risk, the securities are the government bonds. So that has to be option number A. So I think majority of you were absolutely correct. So good round of applause, guys, for starting the session with the while we start with other concepts, especially the weighted average cost of capital, just had a query from Manish in between. For redeemable debenture, book says formula will not show correct. So yeah, so Manish, what happens is when the redemption value and net proceeds difference is high, see, you are just dividing that with the number of years and also taking an average cost in the denominator. That is why generally the accurate answer sometimes can be, actually get by the yield to maturity method, YTM. So if the difference is high, then the actual number might vary because, that could spread across a number of years. So that is the major reason behind that. So we anyways talked about a YTM, and we also will talk about maybe another practice question where we will be talking about YTM as well. So let us start today's evening with the fresh concept, which kind of commingles of what all we did on Thursday. So what all we did on Thursday comes here down on one platter that's called weighted average cost of capital. Now, guys, as the name suggests, we're talking about weighted average. I started Thursday's session when I mentioned that any organization would like to opt for various sources of finance. We talked about of equity, debt. We talked about of expensive source versus less risky source, or vice versa. So if a debt could be a less expensive but could be more risky, equity could be more expensive but less risky. Now that's something you guys would have been doing in the leverage chapter. But having said that, we need to understand the organization would like to, or as a finance manager, don't you think you'd like to make that combination, as a source of capital where the risk is balanced and not only that, the cost is minimized? That would be your objective. Okay, so whatever the combination management decides to, or what is the combination you guys have for a particular organization as a source of finance, we need to see the individual components of the cost of capital for each one of them. That's what we did already. Now we move ahead to calculate the overall cost of capital. Now, overall cost from all those sources. Now, it sounds as simple, but we need to be careful here while we apply the weighted average. So what we do is we simply apply weights to each component here. How do we apply the weights? In proportion to its capital, guys. And then that weighted average is multiplied with individual cost. Sounds pretty simple, pretty straightforward. But yeah, the question is what weights? Which weights do we need to take here? Do we simply take the book value? We have the book value in the balance sheet, or from a practical standpoint, the market value of different sources of capital might be different than their book value. So we might need to see what exactly is the call of the question there. Are we talking about straight away taking book value, or we're talking about from a market value perspective? So there can be a couple of scenarios here. That is the book value of the individual components or based on market value. Now, market value could be little tricky. Market value could be little tricky. What happens is that when you give a market value for an equity share, you get a total market value of the equity cap of that organization. Now, when I compare that market value to the balance sheet, let's take an example that the market price of a share is, let's say, 25 rupees, right? And let's say there are 100,000 shares, 1 lakh shares, right? On the other hand, we have, let's say we have a balance sheet of the company. This is a book value. Here you might have equity, and let's say, so you're talking about a par value, let's say 10 rupees. So we're talking about 10 lakhs here. And we also have something in retained earnings. So let's say the retained earnings is in this case 6 lakhs. Just assuming, right? Now, when we have the market value for these equity shares, the market value of the equity of the company as a whole looks to be 25 lakhs. Now, we need to be ensured that while we calculate the weighted average cost of capital, if you remember, we talked about that although cost of retained earnings could be same as cost of equity, but when it comes to the new equity, the cost could be higher. Can anyone tell me how come the cost could be higher for the new equity? Now, this is what we discussed on Thursday, guys. Let's see what answer you gave me. Just waiting for your responses here on the query box. Why the cost of new equity could be higher? Yeah, Srishti, market price 25 lakhs, absolutely correct. That's absolutely fine. But yeah, I have a question that why it could be higher. The cost of new equity. Due to various flotation costs and underwriter commission is what Kamal said. Yeah, absolutely wonderful, Kamal. That's absolutely correct. So there could be some cost attached to raising of that capital. Now I'm getting responses from other students as well. So that's good. We are already on a two-way traffic here. So Divya, Sanjay, so I got your responses as well due to flotation cost. Absolutely. So that, guys, so that is why, again, we need to understand that since my cost of capital have a separate component as a KR and a KE, even if I'm following a market value as a weight, then what do I do of my equity and retained earnings? So somehow I have to split this market value into two. What basis should I use? If I'm using the market value of equity, I have to proportion that basis the book values of paid up equity capital and retained earnings. So in this case, this 25 lakhs would be a portion in the ratio of 10:6. Guys, I hope I'm pretty much clear here. Now that's very important, right? So this is the same statement mentioned at the bottom, that why the cost of capital or retained earnings could differ, of course, due to flotation cost. And that's why it's majorly that, you need to kind of bifurcate the two separate weights, even when you are using the market. Okay, I'm getting more answers. So let me see. Srishti, you are absolutely right. Priya, Gilberta, so okay, you're talking about because of flotation cost, because Manish says because shares will increase. Manish, not primarily because shares will increase. Again, the cost of new equity becomes higher because your net proceeds is basically low. That's the major answer for that, right? So okay, let's try to implement that with the help of an example. cost of equity of a company is 10.41%. Well, cost of retained earnings is 10% here. There are 50,000 equity shares of 10 rupee each and a retained earnings of 15 lakhs. Market price per share is it's 50, and they're talking about calculating the WSEC if using the market weights. Now, guys, can you see that in this case, the KE is definitely kind of more than KR. That's crystal clear in the question itself. Now, pretty similar to the example I discussed. Now, what's the market value here? What's the market value? So we're talking about 50,000 into 50, 25 lakhs. Share, I would say, a coincidence of what we discussed here in the last example as well, right? So one more zero. So that kind of gets split up into book value. Now, book value is 5 lakhs versus 15 lakhs. So 5:15, guys, or 1:3. That means my equity is 6,25,000, whereas my retained earnings becomes 18.7. That's the remaining number. Or you could just do a quick calculation, that is your balance of out of 25. Guys, I hope that makes sense to everyone, right? So now, since you have allocated that 25 lakhs basis the market value, you have allocated that 25 lakhs here based on the market value. Your original, again, we're talking about, or the 25 lakhs value of a market value is bifurcated on the basis of the proportions you have the book value. You are allocating that as a weights, as the weights. So now I'm having 6.25 versus 18.75, and that's nothing but 1:3. You could, kind of, anyone can say that, okay, while we are kind of calculating these, if we have to apportion that in the proportion of the book values itself, why can't we straight away multiply 1:3 to the respective cost of capital? We could still do that. However, we will talk about something else when, if it all, you have a new equity source of coming in, right? So it's of course this particular source of equity and retained earnings in this case anyways has been given a higher cost of capital, that is 10.41 than 10%, right? So make sure in this case, although it doesn't make a difference here, so we're talking about 1:3 anyways, right? That was the proportion other way around as well. Now my weighted average cost of capital becomes 10.10%. So guys, I hope this is a pretty simple example of, similar to what I was explaining on the last slide, but any doubts, let me know. Else, let's look at a comprehensive example on this particular slide there. Let's see what you guys have to think about this. So this particular case, we have to calculate the weighted average cost of capital both on the book value and the market value as weights. So I would request you guys just to keep a snapshot of this question ready with you in case you want to click a snapshot. Just do that while I will be walking through the solution with you all guys on the whiteboard maybe. I think it sounds to be a good plan, right? So I hope you have that question handy. Let's move to a different Zoom and where we can walk through a good solution for this one. Okay, so what exactly we're talking about a capital structure in this case. So let's try to make up different values here, like what exactly we need to split across, what are the different values in this case from a weighted average cost of capital perspective. Let's note down that maybe one by one. Okay, just give me a second. Okay. So guys, in this case, in this particular question, a very important point is that when we are talking about calculation of individual components, it's very important. We also need to know the methods we need to follow. I'm just quickly going back just to highlight something. While we are calculating the weighted average cost of capital, either at a book value or market value, it's very important that when we are looking at debentures, preference shares, or equity shares, we need to know for what method should we apply for each of the respective elements. Now, they are giving next year expected dividend with annual growth of 5%. I don't think any marks for guessing which method cost of equity will be applicable to. Now, of course, in the cost of equity, we are talking about growth model, right? What about the debentures, guys? Now, debentures, they have specifically talked about. Look at the last line. In the debentures, you're specifically talking about use YTM method to calculate the cost of debentures and preference shares, not only for debentures, but also for preference shares. So let's then talk about this. How do we calculate? Now, first of all, let's keep aside the most easiest one of all, right? Let's try to note down the book values and of course the market values as well, right? So we are talking about debentures, preference shares, and equity shares. So we have some book value for these. So guys, what are the book value for these? So we have equity shares of 10 lakhs. You have preference shares of 5 lakhs. And I believe similarly, you have debentures of 5 lakhs as well, right? So of course, the debentures are having a 10% interest and the preference shares are having a 5% dividend. So we can have a quick note of that as well. What about the market value? So we'll eventually need this weights, guys. Then we'll come to calculation of the cost of capital as well, right? So what are the market value? So in this case, for equity shares, the market value is given to us as 24. So we're talking about 24 lakhs, right? So then we are talking about preference shares of 110. That means 5,50,000. What about debentures, guys? 105. So my total market value capitalization here is 34,75,000. So I have everyone is with me till this particular point, right? Now, who is going to tell me the cost of capital in this particular example? What would be my cost of equity capital, cost of equity shares? Who is going to tell me that? What should be my cost of equity capital? So you talked about growth model. So what would be my answer? Let's see what are the responses you are giving me. Okay, Srishti, Manish, okay, you were giving me the market value. That's okay. Debentures were 525. That's absolutely okay. What about the equity, guys? Now, in the equity, what we are talking about in this case, of course, is the information given to us is a dividend, a growth, what all we need, and of course, the market price as well, right? So Let's see what exactly is KE. Everyone is giving me KE as 10%. Srishti has a different answer. Guys, please be careful of the wordings here. They're saying next year expected dividend is one with annual growth of 5%. So they're talking about they're only giving you the next year dividend, right? Do we need to calculate that? So what exactly do we need to do here? 1 upon, and then you have a 24 minus 4 as a flotation cost plus 0.05. So I guess seems to be 10% to me as well. KE. I think a majority of you are giving me 10% as an answer here, and I think it seems to be okay. Sanjay, yeah. Anushka, absolutely correct. Manish, I think you need to just double check your answer. 10% is it, I guess. Okay, so now we talk about yield to maturity, guys. Now, who can remind me what was yield to maturity? We have to calculate yield to maturity separately for cost of preference shares and also cost of debentures. Let's see what do we have for cost of debentures, guys. Now, let's see who remembers that. What was yield to maturity? What was that yield to maturity rate? What's the significance of that rate? So let's see who remembers that. Okay. That was the rate. Okay. Kamal says present value method. Yeah. So Kamal, yeah, it uses present value, but the idea was where you have a kind of an IRR where you have a present value of the future cash flows kind of equates today's market value. That's what we are talking about, right? So basically we're talking about calculating IRR, right? So now in this case, guys, we need to understand that what is the IRR? What is the IRR? Let's say we start about debentures. So we are talking about debentures which are 10-year maturity period. So today we are talking about 100 cash flow, and then 100 as in like the debenture cost 100 today, and then there is an interest of 10% for the 10 years, and of course then you're talking about as a maturity as well. So that's something we need to be careful about, right? So what exactly will be today's cash flow, by the way? Is it 100 or is it something else? What's today's cash flow from a debentures perspective? Yeah, absolutely correct, Anand. Anand gives me it's the discount rate which the present value of cash flow and inflow are equal. So from a debenture perspective, what we need to understand is let's make those columns here. Let's say this is year. This is today. Then we're talking about years 1 to 10, and then we're talking about year 10. So what is the cash flow, relevant cash flow for today, guys? What will be the relevant cash flow for today? I think if you look at the question, they're talking about there is a 4% flotation cost, if I'm not wrong, and there is a 105 market price, guys. So 105 minus 4%. So that gives what? 0.8. That's today's cash flow, guys. And then the relevant cash flow. Now we need to understand relevant cash flows here. For years 1 to 10, there is an interest of 10, but guys, there is something attached to the interest. And that's what you guys need to know. The interest, of course, will be your after tax. And what is the tax rate, guys? In this particular case, the corporate tax is 30%, right? So when we talk about a tax rate, we need to ensure that we take that benefit. So my interest kind of goes as a 7. So that will be my interest element. And then at the end, 10th year, it will be 100. So let's say if we calculate IRR using YTM, or we want to do a hit and trial, we want to get one positive NPV and one negative NPV. Let's try to calculate, let's say, a first one as at a 5%. Let's take an example of a 5% here. So we need to calculate the discounting factors at 5%. Now, of course, at today, it is 1. There is no need of discounting for time value 0. That's today, right? You don't need to discount today's. But for year 1 to 10, you need to calculate, you need to calculate annuity, which kind of, gives you a total for all the 10 years. Now, if I may want to kind of give you an annuity at different rates, how would that look like? Let's say that, if you just take a simple calculator and you want to, kind of discount just, 1 divided by 1.05, or, take a different rate. So let's say if we do at 5%, what exactly is what we are getting, right? So for the first year, it's 0.952. For the second year, for third year, and so on. And when we add them up, we are getting a 7.7217. That's what we are getting for the 5%. For the 5%, we are getting a 7.7217. Okay, make sense, guys? Okay, I'm just looking at the query box for the responses. Kavya said, determining the cost of that is higher the discount rate, lower the accuracy, that is negative, vice versa. Yeah, absolutely correct. So, so we're talking about 7.7220 from Srishti. I think that's okay. I think maybe due to rounding off, it's just a marginal. I think that's almost same, right? That's absolutely okay. For the 10th year, though, guys. For the 10th year, where you have a redemption, in that case of 100, that's where your 0.61, I guess, 0.6139. 0.6139. So let's see what is the present value here. So you have 100.8. Then when you multiply 7 by 7.7217, would be getting what exactly would be getting, guys? So this is my initial 100. That's my initial investment. And then we calculate a 54. And then approximately 61.39. So we're getting approximately 14.6, I guess, right? So that's what we are calculating in this case, 14.6. Now, guys, you have a positive NPV, we want a negative NPV. And we discussed on Thursday that, of course, for a negative NPV, the other rate has to be a higher rate, because you want to discount at a larger rate then, right? Okay, so yeah, absolutely correct, Srishti. I see the answers given by Srishti, Anushka, and also others. Everyone is giving me good responses. Good job, guys. So that's absolutely okay. Let's say now we discount it at a higher rate. Let's say a 7% discounting rate now. Now 7%, of course, you don't have anything for time 0. Then a total of the 10 years discount factor comes to 7.0236. Right, and then you have a 0.5083 for 10th year as well. And similarly, if I want to calculate present value at that rate, would be again a negative initial investment, giving you 7 into 7.02 looks to be a 49 point something, right? 49.17. And then 0.5083 multiplied by this gives us a 50.83. Yes. Are we getting anything negative here or aren't we? Yeah, I think marginally there, right? It's 100 minus 100.8. So it's a negative 0.80. Now, I want to also make you understand then when we are using a hit and trial method or when we are doing a YTA method, guys, it's very important that we also need what we are trying to do here. As I said, the objective to calculate IRR is that point where the present value becomes 0. That is my objective, right? Now, you can see at 5%, it is giving me 14.6. At 7%, it is giving me minus 0.8. This is present value at 7%, guys. This is present value at 5%. Now, may I ask you, if I have to apply that same IRR formula here, even if I don't apply, before even applying that formula, can you tell me, would my IRR be closer to 5% or closer to 7%, guys, without even using the formula? Logically, let's understand that. Are we conceptually clear? Because at IRR, my present value of inflows and cash flows are equal, right? Yeah, Anushka, absolutely correct. Negative 8.8, that's what I mentioned. But now my question is whether my IRR looks to be closer to 5 or 7, guys. Without even going for the formula. Closer to 7, right? Closer to 7. Yeah. So Anatharam says, Srishti says closer to 7 because see, it's almost 0 at 7. So it might be slightly less than 7, that means. So let's apply our IRR formula then. So we are talking about a lower rate, right? And then we are calculating the NPV at the lower rate. That's 14.6. So guys, I think that comes out to be a 6.90%, right? So, so my cost of debt becomes a 6.9. So we needed a cost of equity. Thus we have with us. We needed a cost of debt that we also have with us. What about the preference share then? What about cost of preference share? Now let's do a similar exercise for the cost of preference share. Let's go back. What were the details of the question itself? Just taking back you to the question here. So what we have done till now is our cost of equity. So we have let's note it down. Cost of equity is 10%. Cost of debt is coming out to be a 6.9%. Now, what we are required to just calculate is, yeah, more accurate answer given by Khushi, 6.896. Absolutely correct. That's absolutely correct. So now for preference shares, we need to do again. So to look at the last line, use YTM to calculate the cost of debenture. So let's go step by step. So this is what we did already, 10%. We calculated 6.9%, right? Let's go ahead and calculate cost of preference shares in a similar fashion, friends. Now, in preference shares, what we need to understand, can anyone tell me what was my market price? There you go. We are talking about a market price of 110. What is the flotation cost or 2% flotation cost here? So that means if I have to invest or the initial flow or a net relevant cash flow for a preference share would be 110 minus 2%. Guys, I hope that makes sense. 110 minus 2%. That would be year 2 here. 107.8. I hope that is clear. 107.8. And the dividend every year for the next 10 years, we are talking about $5 or 5 rupees. Now, in this case, 5 rupee, because we are talking about a 5% coupon rate and again a 10-year maturity. So, and at the maturity level, you are having a 10th year as a 100 rupees redemption value. So I hope this is clear, guys, to everyone. We are all on the same page till now. Akanksha said 2% increase gives 13.8 less values to get. Okay, great. Akanksha has a different perspective to look at it. That's good. But yeah, but it's always better that, you know, we kind of give that a YTM check, right? So, so we're talking about 107.8 minus 5 and 100. Now, let us calculate that using 5% again. We're doing a 5% check here. We use the same factors which we did for debentures, guys. So we did 7.217, right? And 6.139. Let's use the same numbers here. So we're using the same numbers for the 5%. And when we calculate, we're actually getting a negative number here, guys. Negative minus 7.8. I just want to hold on for everyone who are with me or lagging behind slightly. Just want to wait if you guys have any doubts. Now, if we are getting a minus 7.8 here, that means the next discounting for YTM, we have to lower down the number. We have to lower down the number. Of course, we can try for 4%, 3%. Let's do by 3%. Now, when we calculate the discounting factors, you know, we calculate the discounting factors for relevant ranges. So what are the discounting factors for a 3% here? So we are talking about a total of 8.5302. And for the 10th year, we are using a 0.744. 0.7441, right? So let us use that same rate while calculating the cost of preference shares. So we're talking about 8.5302 and 0.7441. And we get a positive 9.26. Okay, so everyone on the same page, guys? Everyone clear for discounting factor 3%? Let me know any doubts. Again, I think the key behind in YTM is kind of calculating various factors where you're kind of getting it more of a practice. Okay. Interesting question from Srishti. Srishti says when I'm calculating it 10%, it's coming to be slightly more as 7%. So Srishti, I think very similar doubt which I think someone else asked me earlier about when the gap is larger, you might get a slight different answer. So it's always better when we're kind of calculating that using the these methods when we are talking about marginally more or less. Like for example, in this case, we are getting minus 7.8 and plus 9.26. I can, by a naked eye, I can tell that yes, something which can be something with between the middle, right? 3 to 5. So we're talking about 5 to 3. We are getting minus 8 to plus 9. So cost of capital should be around 4% in this case. Now, similarly, in that case, then you would have been doing, if you would have calculated that using a 10% or or even a higher rate, you may not be surprised, because what would happen is in this debentures case. So I think I'm talking about specifically to Srishti's query, that what is happening where we are using a much higher rate. Because if I'm using a rate of a 10% or a 15%, then you're looking at a larger gap. So you're looking at a 5%, you are looking at a 15%. Right? So we all know when we will be actually stretching that formula, that when the 15% would be giving you a larger negative number, we know that we have to go into this direction. From 5%, we have to go to this direction. Whether we will actually land up to 6.9 or 7.2, it would be more of a number game then, right? So the idea is that, it's better that you don't create that larger gap. So that would be always better. I think similar query was asked by another student earlier as well. Okay. So guys, I hope everyone is getting minus 7.8 and 9.26 then. Great. So using the same formula, we are getting an IRR. I think some of the students have already given me the answer for IRR. That's 4.09. So I think even by just looks of it, it seems to be between 5 and 3. It has to be between 5 and 3, right? So it's coming as 4.09. Okay, so guys, now we have got 3 elements, right? We have got 3 elements. What all we needed for our weights, right? So we're talking about the original weights here. So again, can we plot the cost of capital here maybe? So let's plot our cost here. So we have a 10%. We have a 4.09. We have a 6.9. What you have to do is nothing but calculate a WACC here using book value as a weight and WACC as a market value as a weight. So we have the weights in front of you. Let's see what answers you are giving me for WACC. It's just that we kind of multiply the respective weights. So like it's more of a 2:1:1 or something like that. So what exactly you want to, how you want to arrive at that, right? So the ratio is 2:1:1 for book value. So what is the weighted average cost of capital for, or rather basis the book value, guys? Let's see who is the first one to respond. So we are getting a 5% here, because that's a 10 into 2/4 or 10 by 20, whatever you want to give. Similarly, a 4.09 gives you something like 1.02. Similarly, that would give you a 1.73 or 1.72, whatever. So what would be the answer then? 7.75, using the book value as a weight. Okay, what about market value, guys? What about market values? Just got some answers. I hope you guys are calculating. So market value, of course, we are talking about 24 versus 5.5 versus 5.25. So anyone who has calculated the market value answer as well? Okay, so market value is, Akanksha says 8.57%. Okay. So what we are looking at here is, yeah, absolutely correct, Akanksha. So 7.75, we have a 7.75 here, and we have a 8.57 here as well. Wonderful. So also interesting factor is that again, when we're talking about calculations, sometimes it sounds to be a little bit of a bare mathematical, but remember we talked about other sources as well. We talk about the cost of retained earnings. We'll also look at certain questions where you have retained earnings as well. But before we move ahead, it's a very important point that we talk about yet another concept that's called marginal cost of capital. Now here I would like everyone to be pretty clear. Okay, so Srishti, I just saw your point, but I think it is already clear. Great. I saw your point about the book value, but I think you are clear now. That's okay. Thanks for confirming. Now we're talking about yet another concept. It's a very important one: marginal cost of capital. Now, marginal means additional, right? So when we look at marginal cost, we are looking at cost of raising an additional rupee, guys. Now, we discussed on Thursday that every earnings which an organization make is not redistributed or distributed as a dividend, but rather some of the earnings kind of get reinvested. Can I ask you, if I'm reinvesting some amount in the business, just you have to answer me yes or no. If I'm just reinvesting some amount in the business, is or rather should my cost of capital increase or change, guys? Yes or no? If I'm just reinvesting in the business, yes or no? Should my cost of capital, increase, change somehow? And mind you, I'm not talking about a weighted average cost of capital. I'm just using cost of capital for that reinvestment piece. Yes or no? Okay, it will decrease as cost of RE is lower, Srishti says. Srishti, can you think otherwise that I may not be issuing any capital? So we discussed that if you're not issuing any additional capital, your cost of retained earnings is actually same as cost of equity. You're not raising any additional capital, then why it would decrease actually? You're not raising any additional capital, right? So I'm getting different answers. Someone says increase, Sanjay says increase, Manish says it should not increase, it should not change. Yeah, I think I will tend to agree with what Manish said. And Sanjay, it will increase. We will talk about when it will increase. In my example, it should not increase actually, because I'm just reinvesting. See, what happens is, as a general rule, let's talk about two things. As a general rule, we say that yes, KR is equal to KE. The exception is new equity. We are not talking about new equity yet. Second, let's talk about another general rule, is that generally the companies intend to maintain the capital structure. Capital structure means the proportion. Now, the question is that, okay, when we are looking at, let's say, if I have I need some additional funds to expand, right? If I need some additional funds to expand, and I want that, okay, out of, let's say I need 5 lakhs. Okay, I think that out of my current operations, I can, let's say, claw back 3 lakhs of retained earnings. I can reinvest 3 lakhs. Now, if I need 5 lakhs, what I will do is, let's say my equity is 60%. My equity is 60%, and I have a retained earnings of 3 lakhs. That means if I divide 3 lakhs divided by 60%, it will be giving me 5 lakhs. That means I needed 5 lakhs for expansion, and I got 3 lakhs by the retained earnings. I don't need any more equity. Although it is absolutely correct that for the remaining 2 lakh, I might be going for preference or debt, whatever my existing capital structure is. I want you guys to understand this, please. I took an example that I need 5 lakhs to expand. I'm telling you the proportion of equity in my existing capital structure is 60%, 60. I'm also telling you that I can reinvest 3 lakhs from my current earnings or from my retained earnings into the business. So if I can reinvest, I can generate 3 lakhs from the business itself. And if I divide like how much that portion contributes to the 100% level, it's 5 lakhs. So that means if I raise something more from preference or debentures and I kind of reinvest the retained earnings, then I am not going for a fresh equity till that point. But my question to you all is, in my example, when will I require to raise additional equity, guys? Akanksha says, why it would be constant since retained earnings would have some cost also, which is equivalent to cost of equity. Because Akanksha, equity, again, when we are reinvesting, the funds remain in the business, right? So you're not incurring any flotation cost. So you're not incurring any additional cost. Look at from a balance sheet perspective. You earlier had something sitting in the retained earnings. Now that's going on to your business. That's it. Okay, so my question is now, so there is no change in the capital structure, by the way. I think you guys are confusing that if I'm reinvesting, whether I'm reclassifying my retained earnings to equity. Of course, that's not happening, because reinvesting the money, of course, is something which is represented by retained earnings itself, right? So it's a concept which you need to understand. One side you have assets, other side you have liabilities and equity. Now, coming to my question here, at what point do you think I need to raise fresh equity capital? Let me see if anyone has answered that. In my example, do you think that there will be a point? Okay, Srishti answered, if we want to raise beyond 5 lakhs. So Srishti, that's absolutely correct. If we have to raise beyond 5 lakh, let's say 6 lakhs, then that additional 1 lakh will be in the ratio of 60 is to X is to Y, whatever. Like I might have to raise additional 60,000 from equity shares, and then my flotation cost might impact me. Guys, if you look at this diagram on the right hand side, is exactly that point. When you have to raise additional finance from outside, that's where your cost of capital, kind of your WACC, gets a slight bump. And that bump is nothing but, there we are calling about from a marginal cost of capital, right? So, okay, let me ask another question then. If you understood this example, if you understood this diagram, let me ask you another question then. Can I say that up till a particular point, my marginal cost of capital is actually same as weighted average cost of capital, guys? Can I say that? Till a particular point, my WACC will be equal to marginal cost of capital? Yes or no? That has to be, right? Because till the time I'm not going for additional capital, that will be same. Beyond that, it will increase, right? So let us see. When a firm raises funds in proportional manner, now this is the second rule I was talking about, and the components cost remains unchanged, there will be no difference between the average cost and the marginal cost. So those costs may remain constant up to a certain level, beyond which it will increase. So I hope It makes sense because guys, this is a very important concept. You guys literally need to know this, right? So let's do one thing. So I'm just seeing some responses here. Yes, so Manish, absolutely correct. So that's absolutely perfect. So that till that point that will be equal. So let's look at a comprehensive question here itself. Right? Let's understand that from a question itself. Just give me a second. Let me just go to the whiteboard. Let's understand this from an example here. Okay. Okay, so let's look at some facts first. So we are looking at Dhamaka Limited has the following capital structure. Examine which is considered to be optimum as on 31st March 2019. Okay, what's the capital structure here? 14% debentures 30,000, 11% preference shares as 10,000, equity shares of 1,60,000. So total of 2 lakhs. Company share has a market price of 23.6. Next year, dividend per share is 50% of year 2019 EPS. Following is the trend of EPS for the preceding 10 years, which is expected to continue in future. Company issued new debentures carrying 16% of interest, and current price is debentures is 96. Okay, so we're talking about a scenario where the preference shares are also there, 9.2, annual dividend 1.1, and the company is in 50% tax bracket. Wonderful. So what all we have to calculate? We have to calculate after tax cost of new debt. Guys, who is going to help me in calculating after tax cost of the new debt there? Who is going to help me calculate that? What would be my after tax cost of debt in this case? So let's do one thing. Let me just quickly take these points and let's discuss this one by one. Okay, just give me a second. And let's understand what would be the answers now. Okay, so what would be the cost of debt, guys? Let's see if anyone has answered that already. Coming in from Arihant. Arihant says 8.33%. Interesting. Already getting some answers here. So first point, cost of debt. So we are talking about what is the interest, guys? Cost of debt, I think 14% debenture. So what exactly would be the cost? Okay, so the new debentures, by the way, is 16%, right? So 16 into 1 minus tax rate. And the current market price is 96. So 8 upon 96, it sounds to be 8.33, right? 8.33%. That looks to be okay. What about cost of new preference shares, guys? What about new preference shares cost? Srishti says 11.96. So again, you're talking about preference dividend. So preference dividend is 1.1. So we have it at that bottom 1.1. And we're talking about a 9.2 with an again annual dividend, and the preference share price is 9.2. So 1.1 upon 9.2. So 11.96, or obviously could be 12% as a round figure, but that's okay. Now, new equity share, assuming that new equity is from retained earnings. Guys, if you're assuming that new equity is from retained earnings, my question is, what exactly do we mean here? So they're talking about existing equity or new equity, guys. What do you think? Existing or kind of a reinvestment? I think the bracket says it all, right? The bracket says it all. So new equity share, assuming new equity from retained earnings. So let's calculate KE. So we have a D1 upon P0 plus G. Now, what is G, guys? Now, if I look at over the last 10 years data, do you see a trend here? 1 to 1.10, 1.10 to 1.21. Every year, it seems, even in the last 2 years, I could see almost 10% hike. So can we say that growth is actually 10%? Right? So, and we are talking about a scenario where, they're talking about expected to continue again. And next year, dividend is 50% of 2019 EPS. So that means my D1 becomes a 1.18, friends. And they're giving us a market price on the top of 23.6 plus 10. So what's that, guys? What is that percentage? I guess a 15% would be your cost of equity in this case. Okay, I can see responses from Arihan, Srishti, Kamal. Great, guys. So I think amazing. I guess, as always, you guys are tremendous in terms of responses. Let's look at some additional aspects that's from a call of the question perspective. What all we have to calculate apart from all this, right? So let us see that part as well. Now, once we are done with all these aspects, the next part of the question is talking about something else. So they're talking about calculating the marginal cost of capital when new shares are issued, right? So if that is the case, we need to ensure that what will be our weighted average cost of capital, right? Just give me a second. Let me just remove this and put this across. Yeah. So now the call of the question is calculate the marginal cost of capital when no equity or no new shares are issued, right? So in this case, if there are no new shares, that means it's pretty simple to calculate, I guess, because there is no additional flotation cost that's coming into the picture there. Now, if that is the case, what is my capital structure, right? My capital structure was, looking back to the question, we are talking about 30,000, 10,000, and 160, right? 30,000, 10,000, and 160. So you had 3:1:16 as a ratio. So if I'm looking at option number B here, then my weighted average cost of capital or the marginal cost of capital would be nothing but the weighted average cost of capital. So you have a ratio that is given to us in the capital structure, basically, where we are looking at scenario that the individual components are going into each respective element weights. So I hope that makes sense to all of you, right? So let us quickly look at that as well. So what is the answer, guys? Anyone who has calculated? Anyone who has calculated that based on the weights? So just plotted the weights again for your reference. So 30,000, 10,000, 160. So the weighted average cost of capital based on these is again 3 upon 20 multiplied by 8.33 plus 12 upon 20 or rather 1 upon 20 multiplied by 12 plus 16 upon 20 multiplied by 15. So that would be giving you the weighted average cost of capital. So that would be coming out to be 13.85 exactly. Just double check the calculations, guys. Is everyone on the same page? So Arihan says 13.85. So is Anand, Anushka, Srishti. Absolutely correct, guys. Good. Let's look at the next question then. Determine the amount that can be spent for capital investment before the new ordinary shares must be sold. Something very interesting here. Now, what they are asking us to calculate is what, or how much we can kind of reinvest. Maybe that's what they're trying to say, right? So, guys, do you think what do you need to calculate here? That means we know the capital structure 3:1:16, right? That's what we know. We know for question number C, we know there is a capital structure 3:1:16, 16 being equity, of course. What is that we can reinvest, right? So when we are looking at logical side of things, then we need to understand what will be my retained earnings. What will be my retained earnings? Can anyone tell me what will be my retained earnings, guys? I think we just discussed that. What will be my retained earnings for 2019? So we are talking about assuming that retained earnings for next year's investment are 50% of 2019. So that means 2.36. So we are talking about 50% of 2019 earnings. So my 2019 earnings, let us see what are my 2019 earnings. So we are looking at a 2.36 multiplied by what are my 2019 earnings, guys? Or 2.36 that multiplied by number of shares we have, that's 10,000, right? And we are talking about retained earnings are absolutely 50%. So can we say that we are looking at a 1,18,000, friends? Or rather, I think one extra zero here, right? 11,800. Great. So it's 11,800. 2.36 into 10,000, that gives you a 23,600, and then multiplied by 50%, giving you 11,800. So that is what they are given to us. Now, 11,800 is something which you can actually, reinvest. So then the question is, what amount that can be spent for capital investment before new ordinary shares must be sold? Then is the answer 11,800, guys? No. The question's call is for capital investment. Now, we know that equity shares only form 80%, right? 16 by 20. So the capital investment before new issue shouldn't be 11,800 upon 80%. Shouldn't that 11,800 represent that 80%? Absolutely, right? So 14,750 is what many of you have already mentioned in the query box. 14,750. Right? Make sense, guys? 14,750. And then they're asking you as an option number D, compute the marginal cost of capital when the funds exceed the amount calculated in C. assuming the new equity is issued at 20 rupees per share. Now guys, I think no points for guessing. What we need to do for option number D is, can anyone tell what different we need to do for option number D, guys? Marginal cost of capital when the funds kind of exceed the amount calculated in C. Can anyone tell that? What will be the different scenario then? What would be the different scenario? I think the only thing we need to do is we have to calculate the new cost of equity, I guess, right? New cost of equity. That's the only thing. So for the additional finance, the new cost of equity will be a 1.18 upon 20 plus what was the growth rate, right? Yeah, 10%, right? So we had a growth rate of 10%. So that should come out to be 15.9%, isn't it? New cost of equity, and then my marginal cost of capital, of course, kind of considering the same ratio, right? So we are talking about additional finance then. So we are looking at again a 3 by 20, 1 by 20, and a 16 by 20, right? So 15.9 to 16 by 20 plus your cost of debentures was 8.33 multiplied by 3 by 20, and then another one was your preference, 12 into 1 by 20. So that will be your cost of capital for the new capital as a weighted average, or in other words, the marginal cost of capital after you are kind of issuing a new source. Okay, so what is the answer, guys, in this one? Let me see if anyone has given that answer. 14.57% is what I'm getting from majority of the students. 14.57. Now I want you to look at this. 14.57 is what you are telling me. 14.57. And my earlier cost of capital was 13.85. Guys, did you see that increase? From 13.85, you went up to 14.57. Guys, making sense? Okay, so I'm just seeing more responses. Gilberta, we are talking about from Arihant, Srishti, Kamal. So all the answers are absolutely correct, guys. That's absolutely wonderful. So I think this is a very, very good comprehensive example, but I think you guys are absolutely rocking. So, again, absolutely all the right answers. So that definitely calls for a good round of applause for everyone here. Okay, so that kind of wraps up our conceptual discussion part, guys. Let's kind of take a quick 5 minutes fresher break. I believe it's almost 7:19. So let's take a 5 minutes break here, and then let's continue our discussion with some more practice questions on the other half of this lecture. See you then after 5 minutes. Okay, so welcome back, friends. So we have a lot to practice now, but I was just looking at the query panel and I just saw one query from Srishti. I think Srishti, you were asking me about effective interest rate method. I guess the point which is talking about with respect to on your modules at towards the flag end, which again talks about similar to what we discussed in the YTM, right? So that's nothing but the rate that discounts your future cash payments or receipt throughout that financial asset towards the carrying amount of a particular asset or a liability. Now we talk about YTM for calculating cost of debt at an initial stage. At an effective rate, you may have a carrying value at any point of time. You may have the future cash flows, and the rate that discounts that to the carrying value of the financial asset or an amortized cost, that is nothing but your effective rate. That's similar to that concept, but yeah, you are comparing that to a carrying value. Again, that is something similar, used when we are talking about debentures. We are issuing that on a premium or a discount. What would be the premium or discount? So effective rate actually helps us to calculate the premium or discount, right? So that's where it is majorly used. And also sometimes when we're talking about variable cash flows with respect to any contracts, or especially where the interest rates are fluctuating, then also effective interest rate can be used. Okay, so guys, now we will be resuming our discussion for more practice then. And so the questions on the screen, I guess everyone can see. The first practice question post break: a company wants to raise additional finance of 5 crore in the next year. Company expects to retain 1 crore earning next year. Further details are: the amount will be raised by equity 3:1. Additional issue of equity shares will result in price per share being fixed at 25 rupees. Debt capital raised by way of term loan will cost 10% for the first 75 lakhs, 12% for the next 50 lakhs. Now, net expected dividend on equity shares is 2 per share. Dividend is expected to grow at the rate of 5%, and income tax is 25%. Now, there are 4 requirements: determine the amount of equity and debt for raising additional finance, right? And determine the post-tax average after cost of additional debt, cost of retained earnings and cost of equity, and the overall weighted average cost, guys. Now, interesting thoughts, but yes, we need to understand from a perspective of if we are calculating the cost. If I look at the very first point, that we have to determine the amount of equity and debt for raising additional finance. What do you think, guys? What do you think? What would be my amount of equity and debt for additional finance? Be careful, we are looking at this word additional here. Can I get it from you guys? What should be the amount of equity and debt for additional finance? Don't tell me that answer is in the first line. We're talking about additional finance of 5 crores, but there's something else written as well after that. You're expecting to retain 1 crore earning next year, guys. So what do you think if we are talking about raising additional finance? If we are talking about raising additional finance, what would be the additional finance to be raised? Would be 5 minus 1, 4 crores. But what will be the equity and what will be debt in this case? Can we do it this way, that we are kind of already excluding 1 crore there? Or should we first divide between that ratio? Can we do it that way? If someone thinks that way, we need to be careful. You might go slightly wrong, because what we are doing in this case is we are excluding retained earnings, but that is anyways part of, including the retained earnings as well. So that means if you exclude this one here, you might not come up with an accurate answer. Your ratio might disturb. So what better approach is, rather take the 5 crore itself, take the 5 crore, first of all, split that into 3:1. We calculate that as a 3:1. So what would be my ratio then? 3:1, right? So if we are calculating 3:1, I am thinking of a 3.75 of equity and 1.25 rate. Now, out of that 3.75, you can assume that yes, one is your retained earning. I hope this makes sense, guys. This is much better. If you are thinking that 5 minus 1 of 4 and then you divide, then your eventual ratio will be disturbed. So don't do it that way, please. Okay. So 3.75 and 1.25, I guess. Yeah, Anant, I guess you understood what would have happened. If we could have given the balance 4 into 3:1, you would have done 3:1 and then you would have added. So you would have actually, if we divide that 4 crore, we would have disturbed this ratio. We would have made this ratio as 4:1, which would not have been a good idea, right? Because the amount will have to be raised by equity and debt in that ratio, right? So a 3.75 and 1.25. That is absolutely the correct approach. Okay, so I think, yeah, Srishti, absolutely correct answer. Then looking at other responses, Manish, Rama, Kavya, Arihant, yeah, absolutely okay. So I hope now everyone understands. So why we did that and why not 4 crore route, because that would change the ratio. Okay. Now, the second question is to determine the post-tax average cost of additional debt. Post-tax average cost of additional debt. Why we are looking at average cost of additional debt? Any ideas, guys? Any ideas why we are looking at that? So we are looking at a 1.25 lakhs, right? We are looking at a 1.25 lakhs now, rather crores. Now look at that. The third point, we are looking at debt capital will be raised by the term loan for 10% of first 75 lakhs and 12% for the next 50 lakhs. That means within the debt also, we are looking at two types of debts, right? So we are looking at the term loan of a 10% and we are looking at a 12% term loan. And the tax rate which is given to us is a 25% tax rate. So can we calculate what would be my cost in with respect to each one? So 10% less 25%. So my KD will be a 7.5 here and a 9 here. So 12 minus 25%. Will it be a 9, guys, or something else? Just double check. Yeah, 12 minus 25% will be 9%, right? So what will be my weighted average, or rather post-tax average cost of additional debt? Now it's very important that we need one number for cost of debt. Now this is again a 75 lakh and this is a 50 lakhs. So can we do a simple weighted average for just calculating a cost of debt? Anyone who can give me the answer for cost of debt there, guys? So Aditya says average cost of debt because terms for interest rate is different for 75 and 50 lakhs. Absolutely correct, Aditya. What about anyone else? So if we kind of do a weighted average, so we're talking about 75, right? And 50 lakhs, that's almost like 60% and 40%, I guess, right? 60 and 40 or a 3:2. So what would be the answer? So you're looking at a 4.5 plus 3.6, I guess, right? 4.5 plus 3.6 should be a 8.1%. Let's see what are the responses. Yeah. Gilbert gave me correct answer. So we're talking about 8.1% here. So has been given by Arihant Ramakrishna. Absolutely correct. Great, guys. So we know the question number A and B are done and dusted. What about question number C then? To determine the cost of retained earnings and cost of equity. Now, the interesting factor is we know we need to understand from a cost of retained earnings and equity. Luckily, in this case, we're talking about additional finance as such. We're not here to calculate two different rates. So we use dividend growth model. So what is that here in this case? So looking at cost of equity, then let's do it on the top. Cost of equity, guys. Who will tell me? So net expected dividend on equity shares is 2. But guys, we have to talk about dividend expected for the next year, D1. Now, that 2 rupees dividend is multiplied by 1.05. And then we are looking at price of the share that is given to us as a 25 in point number 2, guys. Right? And that is again adding the growth rate as well. So we are calculating, let's see who gives me the answer for the equity capital then. I think Anushka gave me answer 13.4 is what Anushka says. And I think it seems to be 13.4. Right? Okay, what about others? Cost of equity 13.5, 13.4. Srishti says it is already D1. Srishti, why do you say so? Net expected, it's not next. It's not next. I think, Srishti, did you read that net word as next, I guess? Not sure if you did so. Let me know, please. It is not next, it is net. I think everyone giving me 13.4. So that absolutely looks to be a good answer. And now we have to calculate, yeah, absolutely, Srishti, I thought so. And that's how the sometimes the single alphabet becomes so important. So I hope this is clear now to everyone. So let's quickly go to the final call of this particular one. That's we're talking about a weight we discussed already. The weighted average cost for the additional finance. So we had a 3.314, 1 by 4. We multiply with the respective cost of funds, and that gives us a overall weighted average cost of 12.075. So a good question, but again, a good attempt by all of you. And when that happens, you guys know what you get, right? A good round of applause for a wonderful attempt. Okay, so I hope this question is crystal clear to all of you. Just to be careful at one step, which I discussed initially, but I hope that's absolutely okay with all of you now. Let's kind of change the momentum with few MCQs. Let's see what are the answers for question number 1 and 2 on your screen, and you will have 2 minutes for both the questions. You will be answering with the question number on the query box. Your time starts now, guys. Okay, so time is about to up. Let's see who has given the answers. Okay, so amazing. So getting a lot of answers here. Option number C, and the second question, of course, it's not an MCQ, but yeah, you had to compute 13.48. Before I come up to the answers, Aditya, you had a similar query what Srishti asked. So we are talking about D1 is the next year's dividend. Even if it is an expected dividend for this year, it's not D1. So be careful on that. Okay. So everyone is telling me C for the question number 1. That seems to be that was a simple cakewalk, right? Question number 1, which are the following cost of capital required to adjust tax. That seems to be cost of debentures, because that is the reason we tell that this is like rather the other sources of capital sometimes are more costly but less risky, right? We discussed this many times. What about question number 2, guys? Now, equity share capital of 50 lakhs, 12%, preference share capital of 15, irredeemable debentures 35. Cost of equity is given 16%. Tax rate for company is 30%. And then asking us to calculate the cost of equity, or rather the WACC. So what we need to calculate basically here, of course, we are given two things, 16% and 12% here, right? And the only thing we needed to calculate is cost of debt. That's 15 minus 30%, that's 10.5. And then you have to just apply the weights here. So quick answer was 13.48. That's absolutely wonderful, guys. I think all of the students gave me correct answer. Only couple of answers were kind of a little bit, I think, little different from 13.48. I guess you guys realized where did you go wrong? I think Aditya, your answer was slightly different, and also Ramakrishna, I think just check where your calculations are. Okay, so maybe at some point, maybe in the calculation of the KD or in some weights, we did some error. So answer should be around 13.48 or 475. That's okay. Okay, so Arihant, yeah, absolutely correct answer. So let us look at couple of more MCQs then. So question number 3 and 4 on your screen, answer it with the question number. 2 minutes for you guys for this as well. Okay, so last 30 seconds, please. Let's receive 4 or 5 answers till now. So let us see answers then. Which of the following is an implicit cost of increasing proportion of debt of a company here? Now, we're talking about implicit cost of increasing proportion of debt. Guys, what do you think? What would be the implicit? Now, what's the difference between implicit and explicit? Implicit is something which is not in real terms, but kind of implied, not you are actually paying out something. But if I am increasing the proportion of debt, let's look at one by one. It's a very interesting question, by the way. PE ratio of the company would increase. Would the PE ratio of the company would increase, guys? Price earning ratio. So if you are kind of increasing the debt, really, do you think so? Tax shield in the interest would be less. Again, tax shield would depend on the tax rates, right? Equity shareholders would demand more return. Now, guys, what happens if the company increases the proportion of debt here? Now, if the proportion of debt is increased, the equity shareholders might feel a little bit more insecure. Don't you think so? It's like kind of, you're talking about a scenario where, more of debt. So don't you think that you would actually demand more from the perspective that, yes, if you need to understand from a perspective of return on assets, that may decrease. Again, if you're increasing the proportion of debt, then you might have a explicit cost in terms of payment of interest, but implicitly is something from a shareholder's expectation. So option number C, and I think I'm actually literally, enjoying this, looking at majority of you are giving me option number C. That's amazing, friends. That means conceptually you are getting the clarity, because I just saw a couple of answers which were not C, but I guess those of you who did not give me C are absolutely clear now, because the key word was implicit cost, right? So that's very important. Great. So Aditya has a very interesting statement. Equity shares will ask more return, as now beta for the company would increase because of higher risk and higher cost of equity. Aditya, 90% correct. The only thing is that beta is talking about of systematic risk. So for that company, I'm agreeing with you, but may not be the best of the terminology. But your logic is absolutely correct. Your logic is absolutely correct. Okay, so let's look at question number 4 then. Now, question number 4, a lot of you have answered, I think, option number B, I guess, right? 15.25. So you're looking at a preference dividend of 18. The share currently sells for 120 with a flotation cost of 4 and the cost of the preference share. Now, this should have been a cakewalk. Should have been 18 divided by 118, and that's kind of giving you a 15.25. Amazing, guys. So a good participation again, guys, as always. So a good round of applause for all of you. So I think time for a few more questions then. Let's look at some comprehensive questions now. Now, ABC Limited has the following book value, capital structure: 1,000 lakhs for equity, reserves and surplus, 2.250, 500 lakhs, 1,500 debentures and term loans. Debentures are redeemable at par after 5 years and are quoting at 985 per debenture. Current market price per equity share is 60 here. Prevailing default risk-free interest rate on 10-year GOI treasury bonds is 5.5. Average market risk premium is 7%. Beta is given to you 1.85. Preference share are redeemable at 10% premium after 5 years, and currently they are selling at 102. And the tax rate is given to us is 35%. Now, let us see what is the requirement. So of course, we need to calculate the weighted average cost, but using the market value as a weight. Now let's see, when we are looking at a market value, first we talk about the individual cost components. So We are talking about cost of equity, cost of debt, cost of preference shares. Now, even in the cost of debt, I can see two different elements, right? So let's look at one by one. Now, guys, in the cost of debt, we have information which is talking about a redeemable here. Now we are not asked for a YTM here. We are going for a traditional formula for a redeemable, debentures in this case. So when it comes to be a redeemable, we are looking at the redemption value. So we have 8.5%. We have a tax rate of a 35%. So we go to 85 multiplied by the tax shield 1 minus 0.35. We use our traditional formula where we talk about what exactly redemption value minus net proceeds or the market value. So 1000 minus 985 divided by 5, and the denominator is nothing but the average value. So it's kind of giving us almost 5.87. Now that's the cost of debentures, but there is another cost of debt, guys. There is another cost of debt which talks about loans. Coming back to the last slide. In the term loans, they have simply said us there's 12% interest. Guys, do you think we can take that 12% straightforward? I guess no, right? So again, that interest will be tax deductible, right? So a 12% simply multiplied by 1 minus 0.35, calculating that as a 7.8%. And then after that, we move to the next leg. That's the preference shares cost. Now, again, even for the preference shares, guys, you need to understand that they are talking about redeemable preference shares. Now, in terms of redeemable, of course, we are looking at 9% preference shares. What is the difference between the preference share redemption cost and the cost of redeemable debentures, guys? What was the key difference? Let's see who can answer. What's the key difference when we calculate the cost of redeemable debentures versus cost of redeemable preference shares? Let's see who want to answer this. What's the key difference, guys? No tax shield. Absolutely. Srishti says no tax shield. I hope everyone else believes so. And right now remembers and understands so, right? Tax factor. That's what Ayush also said. So the similar formula, but without any tax impact. So preference dividend plus redemption value, again, minus the current market value and the average of that, giving us a 10% cost of preference shares. Now, for the cost of equity in this case, based on the information, it is clearly prevalent that we are using a CAPM model. Now, they are giving us a risk-free rate. Guys, they are giving us a market risk premium, and they're giving us a beta as well. Guys, when we calculate using CAPM, now I want you guys to closely look at my calculation here. Our formula is RF plus beta into RM minus RF, right? So guys, should I do 5.5 plus 1.85 multiplied by 7 minus 5.5? Guys, should I do like this? Is it correct? Is it true or false? Just a quick health check here. Something we discussed on Thursday, we need to be pretty much careful about. Let's see your responses on this. Okay, Sakshi says absolutely not correct. Sakshi says absolutely not correct. This is absolutely not the right way. Sakshi says, I know better than you. I'm absolutely excited, Sakshi. If you guys can catch me here, that's your test. That's where you pass. So you guys have correctly captured here. Like I can see the responses like Srishti says, it is exactly they are giving us the premium, market risk premium. Now this is actually the market risk premium only. This is market risk premium only, guys. Why do you need to minus this again? You have to just 5.5 plus 1.85 into 7. That's what we need to do here. Absolutely not correct. Absolutely not correct. And you guys are amazing as always. So the market risk premium directly given to us. Directly given to us. Right. So I think some of you actually said correct. I just saw your responses. Arihant, you said correct. And a couple of more students. I hope now you understood. So the KE is 18.45, guys. The market premium, risk premium is already given, guys. Market risk premium is nothing but over and above. So premium is the word, right? What extra risk for market perspective? RM minus RF is there. It's already given to you. So don't do that mistake. Now we know that, and now we come to the final leg of the solution, which says weighted average cost of capital. Now, once we know all these numbers, we need to plot in our sources now, guys, but very important here. There, the call of the question was, we are talking about cost of capital using market value as weights. I will be asking you a very interesting question here. Let's see who will be answering that. Let's see what is the market cap here. Equity shares. What is the market value? Current value is 60. So that means we are looking at in terms of lakhs. So these numbers are in terms of lakhs. So we are giving a market value of the equity is 6,000 lakhs, right? That's what we're talking about, because we're talking about eventually in crores, so equivalent numbers here. Similarly, the preference capital, which was a 102, right? 102, and how many shares were there? 5 lakhs. So 102 into 5. Debentures were 1.5 lakhs. So in the debentures, we are clearly given the market price of the debentures are 985. So 985 into 1.5, and the term loans, of course, holds the same value. So you have 500 lakhs. So you get a market value weights here. My point is, do I need to split this equity into share capital and retained earnings? Do I need to split this? Okay. Or in other words, even if I split, will it make a difference? That's a better question. Let's see who wants to answer this. Okay, what are the responses then? Do I need to do that, guys? So answers I'm getting is no, as the cost of RE and the cost of equity are same. That's what Kamal says. Aditya says market cap is this. This already includes retained earnings, so no need to split. Yeah, Aditya, I know that it includes retained earnings, but yeah, I think combining your response and Kamal's response, I think it kind of gives the complete answer. Yeah, I explained to you guys, when we are talking about the market capitalization, that includes retained earnings, that includes the entire equity section. But when Kamal said that, yes, there is no need because the cost here is same. So even if I split, there is no harm, but the cost of capital will remain 18.45. So even if I split this 70.7 into further two legs, those both of them will have a 18.45 as a cost of capital. Will not make a difference. So nothing harm in doing that. But maybe if you are solving this in an examination, it's worth writing a note there. If you are not splitting, worth writing a note. Since the cost of retained earnings and cost of equity is same, the result equivalent cost of equity or a weighted average will be same, even if we split into the book values proportion. So I think that would be always better approach, that you kind of ensure that you get all the marks, right? So you kind of give your justification for any approach you take. Okay, so I think wonderful. I think I saw the maximum response for this question actually. Kamal, Aditya, Gilberta, Manish, Arihant. Then we got it from Sanjay, Anushka, Pulru. So I think all of you, amazing guys. Amazing, absolutely correct. So all of you were absolutely correct. So a good round of applause for all of you for this one. Okay, so let's move ahead then, guys. I think that was again a relatively straightforward question, but yeah, a couple of things were interesting in that. Let's look at another question then. Now, who is this? Mr. Mogambo are here to meet us. So Mogambo Limited wishes to raise additional finance of rupees 10 lakhs for meeting its investment plans. It has rupees 2,10,000 in the form of retained earnings available for investment purposes. Further details: debt equity mix 30:70. Cost of debt before tax up to 180 is 10%, beyond 180 is 16%. They are not sparing us today. Don't you think so? They're after our lives. They're giving us kind of multiple sources of even debt, right? That one portion was easy, and even that is kind of split up into multiple sources. Don't worry, we are kind of practicing hard to make ourselves equipped for that calculation. So EPS is 4, dividend payout is 50%, expected growth is 10, current market price and tax rate. What all we need, right? If you know the concept, they're kind of giving you the entire platter. You have the starters, you have the main course, you have the dessert. It's up to you what is the right sequence, right? How you want to grasp this meal. And if we are absolutely nearing the dinner time, and I'm talking about the starters and the main course, right? So anyways, we'll have the dinner after the class. But let's see how we can use these parameters in the question. It's always imperative that we look at the call of the question. So we have to be calculating determine the pattern for raising additional finance. Let's look at that itself. What should be my pattern for raising the additional finance? I want to listen from you guys. Let's see what are your responses. What should be the pattern for raising additional finance? Srishti is in full form today. So Srishti is giving me some answer here. Okay, so I'm getting answers. Srishti says 2.1, 90, and 7 lakhs. Gilberta says 3 and 4.9. Interesting answers. Guys, debt to equity ratio is 30:70. So that means we're looking at equity. We're looking at a 7 lakhs. Because looking at a 10 lakhs, guys. If you're looking at a debt, we're looking at a 3 lakhs. But guys, can you see that we have already something in the form of retained earnings, which is part of the equity? So can we further split that? Maybe a retained earning of 210, which is already there. Make sense, guys? 210. And also fresh equity here of 490. I hope we are all on the same page. Now, what about this debt? Even in this debt, we're talking about a 10% up to 180, and beyond 180, it's 16%. So don't you think that kind of also spells it up, like 180, 10%? And then a 120, that's having a 16%. Something like this, guys. That's your kind of pattern for additional finance. So let's see your responses. I'm getting many more responses now. Amazing. I'm getting equally excited. So 210. So let me see who is responding who. So Kamal is saying debt 3 lakhs, equity 490, return earnings 10, then equity share capital again. Okay. Anand says 490, 210. Okay, that's absolutely correct. Anushka, your point is also okay. Yeah, I think more or less, you guys are more or less giving me the right answers. It's just that I'm going into further more split up, right? So this is exactly what we are looking at. Right, so a 7 lakhs equity, if you look at the first answer, that's what we are discussing right now. A 7 lakhs, that's including 210, so additional share capital of 490. Right, now the second question is post-tax average cost of additional debt, cost of equity, and retained earnings. Now, in terms of debt, there are two types of debts, 10% and 16%. So for the 10%, we have a 5% cost of capital because we are talking about a 50% tax bracket. The last point in the question which is given is a 50% tax. So my cost of capital gets changed from 10 and 16 to a 5 and 8. So we are talking about a 5 and a 8%. That multiplied with that ratio, which ratio? Not 70-30, the ratio of the 180, 120. 180 and 120. That's a split of 300,000. That's a 60% and 40%, giving us a additional debt cost of a 6.2, guys. Hope it makes sense to everyone. Yeah, I already saw answers coming in from Anand, 6.2%. Srishti said 10% का 5 है, 16 का 8 है. Yeah, but yeah, you're calculating the average cost. That's 16, that's 6.2. Absolutely correct. Then we look at the equity and the retained earnings. So there is an information which is given to us. EPS of 4, dividend payout of 50%. And then expected growth is 10%. So that means 4 into 50%. That gives us 2, right? So 4 into 50%. That's give us 2. That's a D0 for us. But for D1, that's 2 into 1.1. That's give us 2.2 here. So a D1 is 2.2. That's how we arrive at. That's from the information in the question itself. 4 into 50% gives you a D0, right? And then there is a growth rate of 10%. So 2.2 is what we are getting. And then divided by 44. So you're talking about a 5 plus 10 kind of giving you a 15% as a cost of equity, guys. Let me know any doubts till this point, guys. Okay, Shrisha says, can you explain debt 6.2? So what we have done here is, Shrisha, that you had a total debt of a 300,000, in which you had a 180. That was a 10% debt. You had a 120. You had a 16% debt, Shrisha. So what is the percentage? out of 3 lakhs, you have 1,80,000. So isn't it 60% weightage? And 1,20,000, isn't it 40% weightage? Can we multiply that weightage with the respective after-tax cost, 5 and 8? So 5 into 60%, getting 3. 8 into 14%, getting 3.2. You add them up, you get 6.2%. Shisha, I hope this is clear now. Let me know if you have a doubt there. Okay, so I hope everyone is clear in that. So accordingly, once you have a 6.2 and a 15%, then you can simply apply your 70% and 30% weights. And that should be giving you a weighted average cost of a 12.36%. Let me know if any doubts. Okay, I hope all okay, guys. So, okay, Srisha, thanks for confirming. You understood that. That's great. And then Anushka said that the debt to equity ratio could be different when we are looking at a 60:40 ratio. Yeah, of course, that will change, right? That will change. Okay, so let us look at one more question, guys. I hope you guys are absolutely in super excited mode. And let me ask something with, from all of you. How's the Josh, guys? I hope everyone is kind of super excited. Just one more question before we end the evening. Let's look at this one. And this happens to be another interesting one. So all eyes on the question, please. So Navya Corporation has a capital structure of 40% debt and a 60% equity. So a company is presently considering several alternative investment proposals costing less than 20 lakhs. Corporation always raises the required funds without disturbing its present debt equity ratio. Now, we need to understand here what they're talking about, that you are raising the required funds without disturbing its present debt equity ratio. That generally has been pattern of the questions anyways. Cost of raising the debt and equity are as under. So up to 2 lakhs, cost of debt is 10%, equity 12. And as you increase the project cost, you could see the cost of debt and equity also rising up. And they're talking about if the tax rate is 50%, calculate the cost of capital of two projects X and Y, whose requirements are 6.5 lakhs and 14 lakhs respectively. So guys, just you need to give me respond. What are we doing here? Okay, so Anushka says the Josh is high, and Sakshi says the super excited mode. Great, guys. So we are all enjoying the session. That's good to know. Manish says, why we add? Okay, Manish has a very interesting question. Thanks, Manish. Although Manish indirectly I touched base upon that in on Thursday actually. So guys, Manish has a very interesting question, which says, sir, in growth model, when we first add growth rate in D0, then why we add the growth rate again? Manish, I'm writing your question on the top. Manish is saying this. Manish question is that here it is already G in the numerator. Why we are adding G here again? Manish, let me give you a hint, and everyone else please respond to this question because we discussed that on Thursday as well. Let me give you a hint. Do you remember we talked about of how we calculate G and what are the rationale behind G? That actually is answer of your question, but let me see what others have to respond. Very interesting question. Let's see why we are adding G again. Okay, Aditya also answering about the other question. That's okay. Some of you have already started calculating the answer to that question, but I just went to a doubt of student. So that's absolutely okay. We'll come back to that question in few seconds. So my question is, anyone who wants to share his thoughts, why this is a G adding again in that formula? Kamal has a point. Price of equity shares will also grow, not be stable. So we need to add G. Okay. So guys, you can share your perspectives. It's all about perspective. I will share you one common perspective that could be satisfactory though, but I want to hear it from you guys first. Okay, so because we wanted to derive future growth rate, that's what Srishti says. Srishti, I would like to go a little bit more in depth than what you said. You said absolutely correct, but okay, let me come back to the answer then. Manish, what you are, so let me ask you, do you agree, Manish, that with this part of the formula is actually taking care of entire dividend only? This part of the formula is taking care of only dividend, right? And when the companies performs, their earnings either get distributed or gets retained. And when they get retained, don't you think that will also help the company to grow? And you remember the way we understood this G as one of the way was B into R? Do you remember on Thursday? So the entire cost of equity is, so see guys, whatever is not being distributed to the equity shareholders is also kind of an opportunity cost or kind of a sacrifice that they're not getting that as a dividend, but rather getting reinvested in the business, right? So that is why that G, which is comprised of B into R, that's your Gordon, and we discussed in the Gordon model how that is calculated. That is actually the answer here. Okay, Anupam said first it is added to make previous year's dividend current year, then we're adding the great cost. Yeah, so Anupam, I'm actually telling you the reason behind that. Okay, so guys, first half is actually taking about the dividend part, the growth in the dividend. Other part is talking about the growth aspect which relates to the retained amount. So guys, I hope this is clear now. Manish, anyone else? Aditya says because the earnings will be expected to grow, this raises our expectations. Yeah, absolutely correct. Absolutely correct, Aditya. Anushka says it's future growth rate that will give rise to the level of investment. Absolutely, Anushka. This is what I was explaining. Right. And similarly, Srishti, your point also was validating what I said. This will not only lead to increase in dividend, but also increase in the investment in the form of retained earnings. Absolutely correct. So I hope this is now crystal clear, but thanks, Manish, for asking that question, because that's kind of adding to the gravity of the conceptual clarity. That's perfect. Okay, so let's come back. So I think some of you kind of answered a little bit of this question. Let's come back to the Navya Corporation. We are looking at a cost of capital of two projects, X and Y, whose fund requirements are 6.5 and 14 lakhs. Let me see who responded to me for this. This should not be taking much time though, but yeah, let me see. I think one answer it came from Aditya. He said for 6.5 the debt will be 2.6 lakh and 3.9 through equity, putting you bracket 2 for both. Okay, so what is the cost then? So the call of the question is cost of the capital, X and Y. What will be the project cost for X and for Y? Okay, I'm getting some answers. Srishti says X is 10.8 and Y is 11.3. Guys, don't you think we have to just kind of giving this into different brackets? So which bracket it will fall? So when we're looking at 6.5, guys. So if you're looking at a 6.5, don't you think that, kind of we can just know which bracket it falls and calculate the respective weighted average cost of capital, guys? So if you look at 3 brackets, the project cost of 0 to 2 lakhs, 2 lakhs to 5 lakhs, 5 to 10 lakhs, and 10 to 20 lakhs. So the only difference is they are giving you cost of debt here. But what we need to understand is your after tax cost of debt. So all these numbers kind of getting divided by 50% or multiplied by 1 minus T, right? So after tax cost of debt. So your tax rate in this case is 50%. So 5, 5.5, 6 and 6.5 is what your after tax cost of debt. Now, weighted average cost of capital within this range is kind of equally multiplied with this proportional, because your weight, whatever the range may be, is given to us as in the first line 40:60. So you kind of maintain that weighted average ratio of debt equity as 40:60. So that weights are there. So you calculate the project cost with each range WACC, which gives you 9.2, 10, 10.8, and 11.3. Now your question becomes pretty easier there. They're asking you project X. X is 6.5. Where does that fall? So project X is following on to third range here. Y is 14 lakhs. So project Y is obviously kind of getting into the fourth bracket. So that's why your answers for X and Y are 10.8 and 11.3. Slightly different question, but yeah, should not be that tough to understand, interpret. So I can see almost 5 or 6 students giving me right answer. In fact, all of those who answered this gave me correct, right? Arihant and Srishti and Anushka, absolutely correct. And then they're talking about another question, guys. Now that's very important to understand. If a project is expected to give after tax return of 10%, determine under what conditions it would be acceptable. We're talking about after tax return of 10%. What will be the conditions, guys? Of course, when we are looking at 10% return, that is the return we are getting. But what are we looking at vis-a-vis the cost? If I look at the project brackets here, I'm just looking at the first 2 ranges, 9.2 and 10. So guys, don't you think I would actually not be willing to accept a project for more than 5 lakhs if I'm getting 10% return? Logical. Any project would be up to 5 lakhs. That would be, I would be expecting if I'm just looking at the first 2 ranges. Let's see what are the responses for this. Kamal says, but 6.5 exceeds 20. What do you mean by that? So 2 separate projects, right? So 6 point was for 5 and 10 and 14 was, so the Kamal, I think where you missed out was we are talking about 2 separate projects respectively. So we're not adding them up. So don't do that. Okay. So yeah, I was coming to the second part of the question, guys. Is it clear? Because they're asking us if the project is giving us a after-tax return of 10%, what situations you will be accepting it? If I look at my bracket, I can see it's only till the 5 lakhs where my cost of capital is still 10%. Because as I am breaching that bracket, I am going beyond 10%. It's 10.8, it's 11.3. So when we're looking at after-tax return of 10%, I am of course looking at a cost that needed to be kind of, rather, if you're looking at from a cost perspective, needed to be, equal to or less than that amount, right? So the only two areas where that kind of fits is under first two categories. That's your project cost, either 0 to 2 lakhs or 2 to 5 lakhs. So that would answer part 2 of the question, guys. And friends, that literally ends our discussion on the cost of capital. And I hope you understood the entire application of what we learned on Thursday and what all practice we did today. And I think we did some comprehensive examples on, the weighted average cost of capital, the marginal cost of capital, some important takeaways. We are talking about cost of retained earnings being a part of the cost of equity, especially when we talked about market-based allocation, whether we need to do that or not. Book value proportion, remember that. The proportion of debt and equity with respect to the additional finance, with respect to marginal cost of capital, that's very important. And of course, the relationship of the various methods of calculating the cost of capital, especially with respect to the debentures. Be careful. Are we talking about YTM method? Are we talking about normal traditional way of redeemable debentures, right? Equity, I think we spent enough time on Thursday where we talk about Gordon model, earnings price approach. We talked about the capital asset pricing model. So I think that was done and dusted. But I guess by this point, you guys should be conceptually clear of each and every granular conceptual point which should be relating to any of these areas. I think you understand that, again, all you need to do is more practice, more questions. I'm sure you will gain more control over this topic as well. So again, this is again, I thank you all of you. Again, I think I just saw a few responses. Thanks for acknowledging that you enjoyed the sessions, guys. Anushka, thank you so much for the kind words. And same here for Khushi as well. Srishti, I think I briefed about illustration 4, which you were asking me earlier. Let me just go to the study material then, because if you were kind of just quickly, I'll just talk a couple of minutes for that maybe. Let's look at that illustration 4 you talked about, right? So I was telling you that where we are talking about a scenario there you have a 0 or a deep discount bonds. So in deep discount bonds, what happens is that you don't give any interest. You don't give any interest, whereas you are talking about a good amount of redemption value. So you are talking about significant discount. So today's value is 2,500. After 25 years, it's 1 lakhs. Deep discount. Can you imagine? 97,500 discount. That talks about a huge interest. But can you imagine value? So maybe the way you need to understand Srishti is think about if today's value of 1 lakhs. If you want to deposit some 1 lakhs today, and someone tells you that after 25 years, I will give you like let's say 15 lakhs. You may not be sure that what 15 lakhs after 25 years will look like. What is the rate of return? You want to calculate that, right? That's what they're talking about. So in this case, 2,500 becoming 1 lakh, and the way they are just kind of calculating is that again taking two random rates in between that getting at approximately a 15 to 16% return kind of compounding. So I think the most important aspect for you to understand is the simple relationship between the future value and the present value. You are standing today, that's the present value, 2,500. Compounded annually for 25 years, that becomes 1 lakh. At what rate? Your annuity tables, your future value table will help you. Don't worry, from an examination perspective, for undoable or uncalculatable numbers, you will have that as part of the question itself. Otherwise, for some few years, 5 years, 7 years, you could definitely do a quick calculation from that perspective. But I hope you understand the conceptual part. Okay, so anyways, thanks for asking that question, and I always encourage students to ask all the doubts you may have. So that's very important, guys. So thanks a lot for joining in. And again, let me remind you for the 3 golden words, which I will keep on repeating in my lectures towards the end. That's your hard work, discipline, and dedication. No shortcut to success. You guys need to be safe. I'm sure we will meet again. We'll be having good journey again together in some couple of topics related to your capital budgeting, working capital management. So I will not be going too far. We'll definitely catch you soon in a few weeks' time. Till then, you guys take care and have a wonderful evening and good night. Take care, friends. Cheers.